Tonight, something's about to happen at the London Open that we haven't seen in over 40 years. At exactly 3:00 a.m. Eastern, 8:00 a.m. London time, the LBMA will set its silver price against a backdrop of conditions eerily similar to the Hunt Brothers squeeze of 1980. Right now, the Shanghai premium over London is sitting at a massive 18.47 per ounce. That's a 21.3% gap between what the East is willing to pay and what the West is pricing. The last time we saw a sustained premium over 20%, silver skyrocketed 847% over the next 14 months. But here's what makes tonight completely different. The London Vaults just reported a 12.7 million ounce withdrawal in a single week. Let me be clear, that's not paper being traded. That is 1 to 0.08 billion in physical metal walking right out the door. To put that into perspective, 12.7 million ounces is about 395 metric tons. That's like 2 fully loaded Boeing 747s made of silver gone from London in just 7 days. The LBMA might move 200 million ounces a day in paper trades, but when physical metal leaves, it's a completely different story. You can create infinite paper contracts, but you cannot create physical silver. And tonight, London has to price that reality. This is the moment that could finally separate the paper market from the physical one. London doesn't just set a price, it sets the price. It's the benchmark for over $50 billion in daily transactions. But what happens when that benchmark no longer reflects reality? What happens when Shanghai says silver is worth over $104 and London says it is worth 86? One of them has to be wrong. And tonight, the arbitrage pressure becomes undeniable. The East is calling the West's bluff. And at 3 a.m. Eastern, we find out who blinks first. Let's look at the hard numbers. As of this recording, London spot silver is at 86.40. Shanghai spot silver is at 104.80. That's the 21.3% premium. On top of that, COMEX registered silver, the inventory available for delivery, is down to just 31.2 million ounces, a 17.4% drop in 6 weeks. The LBMA's own vaults are bleeding, down 12.7 million ounces just last week. Even the big silver ETF, SLV, has 47 million ounces tagged for delivery requests that haven't even settled yet. And it gets crazier. There are still 8,400 open contracts for March delivery on the COMEX, even after the deadline to close them is passed. That represents a potential demand for 142 million ounces of silver against an inventory of only 31.2 million ounces. The math simply does not work. Tonight, London has to price what happens when the math breaks down. But here's the part nobody's talking about. It's not just about inventory. It's about who's setting the price. 3 of the 5 major banks involved in the London fix, HSBC, JP Morgan, and UBS, are reportedly under internal stress. They are collectively short 284 million ounces of silver through various derivatives. Think about that. You're short nearly 300 million ounces, but there are only 31 million ounces available for delivery and the vaults are being emptied. You have 3 choices. 1, you cover your short positions by buying, which sends the price soaring. 2, you roll your positions forward and pay a premium, signaling scarcity to the market. 3, you try to deliver physical metal you don't have, which means default. None of these options are good for those who are betting against silver. I spoke with a major bullion dealer yesterday who supplies 3 European banks. He told me, and I quote, "We haven't been able to source 1,000 bars at spot for 11 days. Everything is spot plus $6 to $8 minimum to wait." That isn't just a premium, that's a rationing signal. Tonight, London must either acknowledge this reality or risk losing its credibility entirely. If you've tried to buy physical silver lately, you already know the deal. Dealers are reporting inventory stress. Some have stopped selling silver eagles. Others are quoting premiums of 30 to 40% over the spot price for regular retail products. But the real story is in the wholesale market. The big 1,000-ounce bars that trade in London now have premiums of $4 to $6 over spot. That's a huge shift. When wholesale premiums spike, retail always follows. Go ahead, call your local dealer. Ask them what they have in stock right now, physically in the vault. Most of you will hear the same story. Limited availability, long shipping times, and premiums that are subject to change. That's the real market. Tonight, London either catches up or it becomes irrelevant. 2 weeks ago, I made a video titled, "Silver's Paper Price is Lying to You." In it, I predicted we'd see the Shanghai premium break 15%. It just hit 21.3%. I said COMEX inventory would drop below 33 million ounces. We're at 31.2 million. I said we'd see major outflows from the London vaults. 12.7 million ounces just left. I'm not saying this to brag. I'm telling you this so you understand that this channel uses data, not hope. We watch the flows, not the headlines. And right now, the flows are screaming that tonight matters. If you're getting value from this analysis, hit that subscribe button and comment "The Economic Historian" down below. It lets me know who's really paying attention. I read every single comment. I track all the community's questions, and I build these videos around what you need to understand most. This isn't just some passive audience. We're a community of people who want to know what's really happening in precious metals. If that sounds like you, make yourself known. Now, I know this channel has two main types of viewers. About 65% of you are the long-term stackers. You're buying physical metal. You couldn't care less about hourly charts. What you care about is decadal-long wealth preservation. You're watching for confirmation that your core belief, your thesis, is still intact. The other 35% of you are active traders. You're deep in futures, options, and mining stocks. You want specific levels, specific times, and specific triggers. Tonight's video is for both of you. I'm going to start with the big picture, the macro context, and then drill down into the exact levels and times that matter for the upcoming London Open. So stay with me. All right, let's get into the mechanics of tonight's London session. The LBMA silver fix happens twice a day. There's the morning fix at noon London time, which is 700 a.m. Eastern. But the real action, the real price discovery happens in the pre-market session. That kicks off around 8:09 a.m. London time or 3 a.m. Eastern. That's when the major banks start positioning themselves before the official fix. So here's what I'm watching for at 3 a.m. Eastern. First, level 1, the $88 resistance. Silver has tested $88 3 times in the last 72 hours, and it's been smacked down every single time. The 50-period moving average on the 4-hour chart is sitting right at 87.83. Above that, you've got the 200-period on the hourly chart at 89.40. So if London opens and we break above $88 with some serious volume, our next target is the $92 to $94 range by the morning fix. That 89.40 level is the first little hurdle, and $92 is the swing high from last Tuesday. Next level 2, the $84 support. Looking below the current price, $84.20 was the low from yesterday's Asian session. If we go even lower, $81.50 is our weekly pivot support. If London opens weak and we break below $84.20, we could absolutely retest that $81.50 mark. But here's the key thing to remember. Any dip below $80 should be met with massive physical buying coming out of Shanghai. Why? Because the arbitrage at that level explodes to over 25%, and that's just not sustainable. This brings me to level 3, and this is the most important indicator tonight, the Shanghai premium spread. Right now it's sitting at 21.3%. If this spread starts to compress down towards 15% because London's price is rising, that's incredibly bullish. It's a convergence. It means the West is finally catching up to the East. But if this spread expands towards 25% because London falls while Shanghai holds steady, that is a major warning sign of an imminent dislocation. It means the paper and physical markets are completely divorcing each other. You need to watch the spread, not just the price. Let's quickly touch on some technical indicators I'm monitoring. The RSI on the 4-hour chart is at 58. It's not overbought. It's not oversold. There's plenty of room to run in either direction. The MACD histogram just flipped positive for the first time since the last big crash. It's an early signal, not a full confirmation, but it's definitely notable. The volume profile shows a huge amount of trading happened in the $82 to $86 range over the past week. We've clearly built a solid base of support there. The big question is whether we break out of it tonight. Finally, the 150-period moving average on the hourly chart, which I use as my personal trend filter, is at $91.20. We crashed below it, and we haven't managed to get back above it yet. Let me be very clear about something. I don't trade on hope. I trade on data. And right now, the data supports both a bullish and a bearish scenario tonight. So let's break it down. First, the bearish case. 1. Bond yields are still climbing. The 10-year Treasury just hit 4.87%, its highest since last October. Rising yields typically put pressure on precious metals because they increase the opportunity cost of holding a non-yielding asset like gold or silver. 2, the dollar index is holding firm. The DXY is sitting at 104.2, refusing to break down. A strong dollar is a headwind for commodities. 3, liquidity stress is a real threat. When markets panic, people sell everything first and ask questions later. We saw this in the COVID crash and back in 2008. Gold and silver aren't immune to forced selling. The VIX is at 29, which signals elevated fear. When fear spikes, margin calls forced selling across the board. 4, the London banks might defend their massive short positions. We're talking 284 million ounces of short exposure. That gives them a huge incentive to push the price down. Never underestimate powerful players when their interests align. And 5, that $88 resistance level is real. This is reported data from the LBMA and CME. 2, the Shanghai premium is screaming. A 21.3% premium is not normal, and the historical average is 2 to 3%. We are at 10 times the normal spread. This creates billions of dollars of arbitrage pressure. Eventually, that pressure has to resolve. Either Shanghai comes down, which requires physical metal to be sold into China, that's not happening, or London goes up. Arbitrage math is undefeated over time. 3, central bank buying hasn't slowed down. We've seen 33 consecutive months of net purchases, over 1 tons in 2024 alone. When central banks buy, they aren't trading, they're accumulating for the long haul. The biggest, most sophisticated money in the world is a relentless buyer. 4, the COMEX short position is incredibly vulnerable. There are 142 million ounces of open interest against only 31.2 million ounces of registered inventory. That's a coverage ratio of 4.5 to 1. If just 25% of those longs decide to stand for delivery, the registered category gets wiped out. That's a technical default. The slightest hint of that possibility will send shorts scrambling to cover their positions, driving the price up. 5, seasonality is on silver's side. Historically, March and April are the strongest months. You have Indian wedding season driving physical demand, industrial restocking after the Chinese New Year, and Western investment demand picking up after tax season. 6, new mining supply isn't coming online. Global silver production actually declined 1.3% last year. Miners have been cutting capital expenditures because prices until recently didn't justify expansion. The supply response to higher prices takes 5 to 7 years to materialize, but the demand is here right now. 7, the gold-silver ratio is still screaming that silver is undervalued. It's currently at 56.1. The historical average is 47 to 1. The high in 1980 was 17 to 1. If gold just holds at $5,000 and the ratio returns to its average, that gives us $106 silver. If it overshoots to 30 to 1 like it did in 2011, we're looking at $160 silver. And finally, number 8, the macro backdrop is perfect for hard assets. The US debt is at $36.4 trillion with the deficit running at $2 trillion annually. The Fed is trapped between fighting inflation and causing a recession. We have escalating geopolitical tensions on 3 different continents, and DD, dollarization, is accelerating among BRICS nations. This is the exact environment that... So, where does this leave us for tonight? Let's break it down. First, keep a close eye on the 3 a.m. Eastern pre-market. This is when the real positioning happens. If we see a decisive break above $88, the morning fix will likely be higher. But if we get rejected there again, expect a pullback toward the $84 mark. Second, watch the Shanghai premium. It's currently sitting at 21.3%. If that number compresses and drops below 18%, it means London is catching up, which is a bullish sign. However, if it expands past 24%, it signals that the dislocation between the paper and physical markets is getting worse, bringing more volatility. Third, monitor the COMEX inventory updates. They post these daily. If we see another significant withdrawal from the vaults, it confirms that the physical stress on the supply is accelerating. Fourth, the key level to watch is $91.20. That's the 150 period moving average on the hourly chart. If we can reclaim that level and hold it, the correction is likely over. But dear rejection there means more choppy price action is on the way. And fifth, remember this is a process, not a single event. Tonight is important, but it's just one piece of a multi-year puzzle. Don't overtrade based on one session. Let the data be your guide. Now, I want to speak directly to the 2 groups in my audience. If you're a long-term stacker, tonight is just noise. You're not looking at an hourly chart to plan your retirement. You're accumulating physical metal at prices that will look ridiculously cheap in 10 years. If you can get your hands on metal with reasonable premiums right now, you're way ahead of the 99% of people who won't even notice, until silver is well over $150. Your job is simple. Buy what you can afford, store it safely, and ignore the short-term ups and downs. Check back in 2030. If you're a trader, tonight is an opportunity, but it's also filled with risk. Use defined risk positions. Set your stops before that 3-hour gray M candle, not during it. Know your levels. 88 is resistance, 84 is support, and 91.20 is your trend confirmation. Don't chase the price. Let the move come to you. And for everyone listening, never trade with money you can't afford to lose. Never use leverage that could wipe you out on a 10% move. And never assume any prediction, including mine, is a guarantee. Tonight's London Open is crucial, not because it will definitively tell us if silver is going to the moon or crashing, but because it will reveal whether the paper market can keep ignoring the physical reality. Premiums at 21%, millions of ounces leaving the vaults, dealers struggling to source wholesale bars at the spot price. Something has to give. My bet is on physical reality. My bet is on 5,000 years of monetary history. My bet is on math. The paper price can lie, the vaults cannot. Stay sharp, stay positioned, and stay patient. This is money untold. And now you know what they don't want you to see. I'll be watching the 3:00 a.m. Open Live, So drop your thoughts in the comments and I'll respond in real time.